Hey Noah. Hey man. So yeah, basically go to tradingview.com, make an account, and get to this point here where you're on the charts. So yeah, basically go tradingview.com, make an account, then products, and then super charts. So products and super charts. And then find this specific Bitcoin chart here on Coinbase right here. And then load up these two indicators here. I'll send you the link to these two. Just these top two here. And then adjust the settings so that it has these numbers in it here. Just so it kind of looks like this. Should be pretty close. Should all be in there already. But if it's not, just make it look like that. And then make it look like this one here. Like these. And then also once you're all finished it, just click save as default. And then for the next one looks like this. Here's all the settings for this one. Don't bother with changing any of these moving average ones. Just make sure that this, which one is it? Make sure all these are the same. And just make sure that moving average 3, make sure, oh, which one is it? Sorry. Hold on 1 second. Oh yeah, okay. So just make sure, yeah, don't bother with any of these moving average ones. We'll do those later. And yeah, save as default and then press OK. And then it should look something like this on your chart with all these lines and stuff. And yeah, once you're set up like that, I'll show you the strategy from this point here. So basically, our strategy follows around this yellow line here. That's the moving average, the 200 moving average hybrid line, that yellow line. And we're only buying in this strategy, we're not selling. So you're just waiting for the price to go underneath the yellow line, like it is here, right here, it goes underneath it. So it comes down like this. And you're waiting for it to tap into one of these white horizontal lines. You can see its origin point here. It's caught like a white impulse candle moving in the upward direction. And you could also call it like an ATR candle. And you can see here it ends right when the candle hits it, the candle body hits it. So right here it hits it and then it continues going red. And then right here you can see it turns green. So you'd be buying right there once that candle closes green. You'd be buying there. And then your stop loss would be underneath it. So you'd buy there. And then your stop loss would be like right there. Or in this case, maybe just a little bit bigger because it's so tight. But in this case, it didn't work out. It was a fail. But that's basically the strategy. So with trading, obviously, nothing is 100% guarantee. You're always going to be losing, but the point is to win more than you lose. So it continues down, keeps coming down, hits in here, and this is actually a red candle even though it's white, but then it turns green here, and then you'd be buying when that candle completes, or even better is the last 10 seconds of the candle. So up here I should mention too, I should have said this first, these are the different settings for the chart. 1 minute, 2, 3, 4, 5, 4 hour, daily, weekly. And I only trade on the 1 minute, so you should be on the 1 minute. So each one of these candles is 1 minute in length. So you'd want to wait for the last 10 minutes for it to close in green color. And when it closes in green color, all that means is that the price, like here for example, this candle is red. So the candle started here at this point here, opened here, and it closed here. So it's red because it closed lower than the previous candle. That's why it's red. So price is going lower here. And then on the next one here, it opened up here at the very bottom, and then it closed here. So now it's green because it closed higher than the last candle. So in this case down here, if we turned off this indicator, the candle's actually red, but because we got the indicator on, it's white. But price move down here, closed red, and then hit this white line, and then it turned to green. So it closed higher than here. So price is moving out, and that's the price is moving up, and that's the move we want to capture. So you enter there. Your stop loss is here, or just a little bit lower. A little bit lower maybe. And then your take profit, it can be coming back up to the moving average, or it could be to the next white line, or it could be a few different things. That part I'm not certain of yet. Or when price starts to move sideways, starts to show some resistance to that level. It doesn't like that level, even though sometimes it can go sideways and then go back up. In this case, it goes back down. So maybe you'd want to like exit here. And yeah, that's pretty much the strategy. So the stop loss thing, I'm not sure if you're familiar with trading, but your stop loss automatically closes your position if it goes past that. So if you got in here, you entered there with $10, and you bet that $10 on there. That means if it went here, you'd only lose $10, give or take. Like if price moved really quickly here, it would slip, and you might lose like 12. But if the market doesn't move too fast, you'd lose whatever you set it to. And then because this is you can see here, it's they call this the risk to reward. So here it's 4.2, or it could be, whatever you set it to. Like you can see as I move it here, it changes. So right here is a 1-to-1 risk to reward. So that means if it hit here, you'd win that trade. It would close out automatically and you'd win $10. If you set it for 1-to-4, that means you would get, 40 bucks, because it's a risk 1-to-4. So that's kind of the skinny on trading. So I would just do paper trading until you kind of get your feet wet. Then after you spend maybe like, I would do it for like a month or two, or until you feel comfortable with that. You can see here's another ATR candle. Price goes back into it there. So it's going red down here, red. Here it turns green, and you'd be entering there again. Enter there with your stop loss down there. And you got to risk 1 to 5.5 there. And you can see it taps the moving average 200. So yeah, like here here you lost this one. You lost this one here, you would have got stopped out because price moved backwards, came up, moved backwards, hit your stop loss. So that's a loss. That means you would have lost, you know, your $10 or whatever you bet on that. But then this one here, you win, you know, 4 times. So even though you might lose trades, you're winning more than you're losing. So yeah, that's pretty much the strategy. I would go and do some back testing and just there's quite a few more things to learn from it, even though that's the basic strategy. So what you want to do if you're serious about it is go and do back testing. So click this little button down here, go to, and then go back as far as you can. Because you're on the 1 minute chart, it's not going to let you go back very far, like September the 14th. And then you'll notice that there's none of those white lines, because the white lines only go back so far. So just open up 1 day. So from this point here to this point here, that's 1 day of trading. So it's from about 8 p.m. to about 8 p.m. again. That's 1 day of trading. So after you do that, click replay and then select bar and then go over here, click that, and then it just cuts off the time for that. So then it'll load all these white lines for you so that you can give yourself an example and you can test what things look like on different days. So you'll only be able to look at about 7 days of trading. So I would go over 7 days and yeah, just keep going over it. The other thing too, you can pretty much stop the video right now and just like play around with that, but there's a couple other things you might want to keep in mind is your trading time when you're going to trade, because the market's open pretty much all the time. So decide like in your schedule where you want to consistently practice trading, because the market's gonna act differently during different times of the day. Because there's New York, there's Asia session, there's Australia, there's London. So the most volatile is going to be when New York is open. So that's Eastern Standard Time. So it works good for us living over here because we can actually be awake during those times. But whatever your schedule is, you're going to want to check that out. So you can go to babypips.com /Fort market hours there, and you can pull this up here and put your times in, and then you can slide this around and see, you know, the times. So at the very bottom, there's New York, opens at 8, which is 5 a.m. our time, and then it closes at 2 p.m. our time, or 5 p.m. New York time. So that's pretty much going to be where the most volume is. Down here you can see where there's lots of volume, so that's going to mean, basically what that means is when you put a trade in here, you enter at the bottom, there's going to be so many people putting money into the system that it's going to move quickly in a direction, which is kind of what you want, because you don't want it to just toggle back and forth going sideways and then hit your stop loss. You want a lot of volatility in the market so that it'll just keep on going in one direction. So when you go and do your back testing, you're going to want to, you know, back test ideally the same time so that it acts similar. But for this strategy, it could act similar anyhow. I haven't checked out too many different times, but it does seem like it's pretty consistent. But I would just for the sake of keeping things consistent and easy for yourself, because you're starting out, I would do the same time every day. So here, 9:30, that's kind of when New York gets busy. So yeah, this would be a good time, 9:30. So right here you can see there's a that ATR white line, you're below the yellow there, 200 moving average, and it hits it, you get a green dot, you get a green candle, and immediately it would have just canceled you out. It would have took out your stop loss. So there it didn't work too. So you can see there's another red line here. That's another moving average line. And then there's a brown one here. There's another moving average line. And that's this indicator here. And that's all these different moving average lines here. So those are all higher time frame moving averages placed on the 1 minute chart. So most indicators you would not be, most indicators you wouldn't be seeing those on the smaller time frame charts, but with this modified one you're able to see higher time frame moving averages like 1 hour, 2 hour, 4 hour on the 1 minute chart, which is really handy. Because after you check out charts for a while, you're going to notice how much more things are sporadic when they get around these other higher time frame levels. So because it's so close to this red one, you might not have wanted to take that out. You might not have wanted to take that trade, I mean, right here, when it did turn, when it hit that and turned green. Like you can see a couple of lows here. They call these swing lows. Couple of swing lows. So it's really common for, like, if you're at this point in time right here, if you're at this point in time and you're looking at the charts, you would be, I should say other traders would be going like this. They would be, this is how people trade. This is how people trade. They were saying, oh, there's a bottom here. If it comes down to this level again, I'm going to buy here. So there's a whole bunch of people buying here with their stop losses down here. And then they would have their take profits up here or wherever. So that's all fine and dandy. But then I'm not sure if it's algorithms because there's people doing algorithmic trading, or it's because people are just trying to take each other out, or it's because there's big investment banks and just big investment companies trying to take other people's money. So they can actually see where people have their stop losses, and they target those so that they can take their money basically. So over here, if Asia is, people in Asia are trading and they've got a position and they're holding on to a position for 1-2 days or a week or whatever, and they're trading this day, they've got a position, and then at the end of their trading day they go to sleep. They're not able to close their positions if they see the market is coming back down or whatever. They're not able to close it. So then time goes on and another country begins trading. They're going to see where that stop loss is, and they're gonna target that. They're going to force the market to go in that direction and take them out, is basically what happens, if that makes sense. So to kind of summarize that into how we're trading, and our example here of our failed, how we failed here, how we got stopped out. We might not have wanted to take this trade here because of the red line, or because there's this level here. See, I just put that line because there's that level there. So sometimes when I see a white line like this and it's close to this horizontal level, I'll actually wait until this level either gets tapped, or a safer entry is wait until it comes through and then enter on the green. So first condition would be it hits this and goes through it and goes past this line I just made and then turns green, and then you'd enter there. And then with your stop loss there, then your target could be that yellow line or wherever. So that's something you can keep in mind, is those higher time frame moving averages, or else it's swing lows like this. And then if we go back more, you can see these, you could call these are all swing lows, like here, and those are swing lows. These are all swing lows, but they're not really that prominent. Like this is a prominent one, this is a problem, this is, you know, the lowest of the lows, this is a prominent one. So like this is another level you want to keep in mind. But when you get more familiar with it, you'll get more accustomed to seeing things. Because I know when I first started trading, people would be talking like that, and I would say like, oh yeah, okay, well you can see how obvious that is. But one thing they don't tell you, and they can't really tell you, is like how far is a far distance and how close is a close distance. Like it's not something that you can like easily explain. It's kind of like how the market expresses itself, kind of. Because like you might have been waiting it for drop down to this level, and it like totally coulda. So that's something you just kind of have to like spend time and like work on it. Another thing too is you can see how you would have entered here, price comes up and it comes back down, and maybe you don't want to enter on there. Maybe your strategy is to wait for the retest. So it comes down here and it retests this first area here. It retests that first green candle area, and then you'd want to enter on that next green one with your stop loss there, or even right at this low here, and then you'd want to target something like that. So yeah, if you put, you know, $10 on this trade, that's a 1 to 2.5, so that would have been $25 win. Yeah, so that's 10 a.m. New York time. What's that? 10 a.m. New York time is 7 a.m. our time. Or if you want, you could have held it for, you know, up until there if you wanted. And if you held it for half a day or whatever that might be, what's that? Just drag that all the way up there. That would be 1 to 12. So yeah, your $10 would have been like $120 about. Yeah, so that's the strategy. Wait till the price goes below the 200 moving average, the yellow one, and wait for it to hit one of those levels, and then enter on the first green candle. Easy peasy. See if we can find another example. Go like a random bar, and 2 p.m. go to, okay, so yeah, so here's about 9 a.m. New York time. Yeah, so here's a white line here. Not that thick moving average line, but the thin one. So yeah, comes up here, comes down towards, maybe you looked at your computer, your phone, and you were at this point in time, and you've seen this line here, and maybe you just want to, you can set an alert here. Can't do it here, but you can right click on it, and you can actually set alerts for when price comes down to that level to notify you. And then yeah, so it hits here, you're waiting for that green candle. Here's a green candle here. I've noticed when price comes down a really long distance like that with a lot of red, that's really hard to have a win off of one of those, so you kind of want to skip those ones. So that'd have been a good skip there. If we look to our right, we got a couple swing lows, couple good swing lows, good swing low there. This is pretty interesting, those really long wicks. So you're right here, so you're right there. It's right around those swing lows. So you can see price takes out those guys. There's not even a red until then. Takes out that guy too. What else do we have? So there's no other really good swing lows over here. So this is a really good spot for the market to turn around. So you could have been waiting here. This is what, like 1, 2, 3, 4, 5, 6, 7. I don't know. That's like 10 minutes. So that's like nothing for waiting time. Wait 10 minutes. This brown line here, that's a higher time frame moving average. So that's a really good level to bounce. That's really common for it to bounce off of there or touch it exactly or underneath it. So yeah, wait for the last 10 seconds for that green candle to show up. There's a 1 to 3. ATR candles way back there. But yeah, it takes out these guys here who have their stop losses here. So they get taken out. Yeah, that's a really nice trade. Worked out good. And that was at 1 p.m. New York time. Yeah, the target, you've got that higher time frame white moving average line there as a target you could use, or the yellow. Yeah, it would hit here, and we'll just play it, see what happens. Yeah, so anyhow, kind of interesting to see how it plays out. So yeah, once again, you're waiting for price to go underneath this moving average, that yellow line. Yep, here we'll do one more example. Okay, so here's Sunday, Sunday 9. This looks like kind of a volatile day. So yeah, here's about 9. This is kind of interesting here. Look at this huge ATR candle here. There's the midpoint. Price comes back in, turns green, target 200 moving average, and there's your winner. So some other times when it doesn't work is like here. Here's a white horizontal line, turns green, and then it just kind of goes down. You get knocked out. So this distance from this green to that yellow line, it's just so tiny. So you don't want to take those ones, even though they can work out sometimes. They're just too risky, so that's too close. So you don't want to take those ones. That'll save you some losses. So definitely keep that in mind. But yeah, if you jumped into that trade 8 a.m. New York time and you just held it, like that's a pretty savage win. Actually, is this the same example? No, I think it's different than before. So yeah, again, price keeps going up, 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 starts coming down. Same thing here too. You're just too close to the moving average, so you wouldn't have taken that one. Price continues to move down. And it's coming down pretty hard here. So yeah, you wouldn't want to take in that one. Taps into another one, would have got stopped out again. And then it comes back down to this interesting area here, that brown moving average line plus that red one. So you've got two moving averages, a really strong level. Plus you've got these white lines where they're really close together, showing that there's a lot of orders down here, a lot of people that have a lot of volume. People have been done a lot of buying here in this tiny little area, so that's a really strong support level. So that's another thing that you kind of want to keep in mind, is that that's going to be a really strong area. So that's, and another way of putting that is it's a really it's a point of interest. Yeah, so another really good opportunity area. So price goes through it, like it just seems like it obviously wants to go to an area, and then once it gets to that point there, you've got that first green one, and then you've got kind of like a what would you call that? It's an impulse candle, but it's got a long wick, so it's like price moved around a lot there. So you could have entered here, you might have entered there with your stop loss there, and then you might have got knocked out there too. So maybe you want to wait until maybe that price came down to these two white horizontal lines. You could have waited then, or you could have just waited for it to kind of hit that. It kind of comes up like this, reaches back down, and then in your mind you should be thinking that it found support there. So that's the retest zone. Here's the retest. So comes down, waves up, retest, and then goes back up. So it had one retest and then it took off. So definitely safer trades for sure if you wait for those retests, for sure. So this one is really red even though it's white, and then there's your green one, free to buy on. Wait until the last 10 seconds where you're sure it's going to turn green, and then buy on that one with your stop loss there. Maybe in this case, maybe do it like there just in case. But those are pretty high probability setups. And then your target there maybe. And that's pretty much it. Yeah, so here, even though we have our take profit up there. It never makes it. You would have got like 1 to 3 there, and yeah, you would have got stopped out here. But some people too, like, really common trading is to say like you enter here and then maybe you wait until price goes past like 1 to 1 or 1 to 2, and then after that you move your stop loss here so that if it does come back to that level, it'll be at break even, so you won't lose any money. So you could do that too if you want to wait until it gets to a 2R, or you could even set it so that your break even is at a 1R. So then if price goes up like this, passes this point here, and then if it comes back down to this level here, then you get stopped out, and at least you get like a 1 to 1. But yeah, look at the price blows through all this area here. And then let's see what happens. And then it starts to go back up. It's that moving average. And if we zoom in, it's all red until here. You get a tiny little green one. And then quickly goes back down, turns green, and then there's your opportunity to enter. So yeah, goes right through all these guys, takes out all that orders or whatever you want to call it, and then it starts to run back up. So that's another good trade. Yeah, so there's 1 to 3. So maybe you got stopped out here for break even, but then this is a 1 to 3, so you know you made money. Just had to wait for those times. Yeah, but let me know if you have any questions. Yeah, man, it's pretty good stuff.